Okay, let's talk about bond insurance, or what's called a credit default swap. A credit default swap acts like insurance policy on the default risk of a corporate bond or loan. This was huge in the financial crisis 2008 2009 because so many companies had taken out credit default swaps on mortgage backed securities. And so they looked at mortgage backed securities and they said, oh, these are very risky. So what I'll do is I'll buy a credit default swap, AIG being the one that issued so many of them, and say, oh, the insurance will pay off. Well, insurance is regulated, and insurance is mandated by the state governments, usually the states, not the federal government, but the state government, to have collateral for these insurance policies. In case something happens, you actually have to have the assets to be able to pay the person's policy off if something happens. So if you wanted to make a lot of money, you'd go down to Florida and you would sell a lot of hurricane insurance, and you simply would wait for the hurricane to happen, keep collecting all the premiums, and when the hurricane happened, you'd simply go bankrupt. And that would be a really easy way to make a whole lot of money because you'd never actually have to pay off. The problem with that, of course, is that that's a total ripoff for the customer. And so you actually have to have the collateral. Warren Buffett has many insurance companies, Geico, General Re, etc., and he has an awful lot of capital. So everybody's confident in buying insurance from him because he has cash that he can hand you in case something bad happens. And not all insurance companies have the same amount of collateral, therefore, or the same amount of coverage. So you have to be careful of who you get insurance from, because right when you need it, if they go bankrupt, you're not going to be able to collect. So credit default swaps is a way of transferring that risk from the person who has the loan to someone else, and of course they pay a premium for that, like they would an insurance premium. And the insurer agrees to buy the bond or default in a default and pay the difference between par and the market value. It goes to the CDS buyer. So essentially it's insurance, but it wasn't regulated like insurance, and that of course causes a problem. Credit default swaps are institutional bondholders, banks, etc., use them to enhance credit worthiness of their loan portfolios. In other words, you can borrow money on a lower instrument of debt, but if you put a credit default swap on it, you're guaranteed to get it pay it back, so you can get a better interest rate. It can also be used to speculate that bond prices will fall. In other words, you can have more CDS outstanding. In other words, if there are more credit default swaps outstanding than there are bonds to insure, therefore you could see that bond prices might fall because people are issuing insurance on them, or people are buying insurance on them. So looking at how many credit default swaps are out there could give you an indication of what's going on in the marketplace. Premiums on German sovereign debt. Remember, Germany had a little hiccup. So you can see that they've gone along, and then they spiked in 2009 like everything did, and they went along fine. And then they went back to May 2011. That was the European financial crisis, and they've stayed pretty high over time. Spain has even risen higher. As you can see, these are two different scales. This is an interesting lesson, and remember to read your scales because they look the same, but they're not. This is 0, 250, 500, and this is only 200, so it's much flatter than this curve. If you put these scale to scale, you would get a different result. So make sure you're paying attention to your scales. And of course, Spanish debt is much more risky than German debt. Therefore, you've got differences in their premiums of the credit default swaps. Credit risk and collateralized debt obligations. Collateralized debt obligation is to take a bunch of loans and collateralize them, or bring them together and pull them into the market and sell them off. So mortgage-backed CDOs, or mortgage-backed securities, collateralized debt obligations, were a huge disaster in 2007, 2009. They pooled all these bad loans together and sold them off into the marketplace. And of course, they cut them into pieces, as we showed in corporate finance. They cut them into pieces, and so they basically changed the credit rating from junk to something higher than that, which of course mispriced the risk. And when you misprice the risk, you end up with problems. So the way they did that is they started with a senior tranche, which was 70 to 90% of the principal, which means that even if there's say 1,000 bonds in this, or 1,000 home loans in this one bond, that 70 to 90% are always going to pay off. So we're going to rate that AAA. and then they got a tranche at 5 to 15%, which is investment grade, and then 5 to 15%, which is junk, and then 2%, which is like your first loss. They're probably going to not make it, but you can roll the dice with those, and they're very high. So when they break it into these pieces, they took something that was in a bad risk to begin with, and they said, well, 79% of it, even though it's a bad risk, will turn into AAA because not everything will go south at once. And of course, guess what happens in 2009? Everything went south at once, and this 70-90% was no longer 79% in AAA. It was more like the 15% junk rating, and of course, it was mispriced. So everybody lost their shirt in that one. And of course, we had government bailouts and so on and so forth. And you can look that up in the books. We'll cover it. We've covered it in other places. But that's a collateralized debt obligation. They simply take the debt of a pool of mortgages or a pool of loans and collateralize it or pull it all together and then sell it off into different securities, and they can break them into pieces. And so this set of bonds is sold off into, in this case, 4 different pieces. And the first 2%, well, you might lose your money. Therefore, you're going to pay the highest interest rate there. And then the junk ratings, you're going to pay a little bit less interest rate there. And then investment grade, you'll pay a little bit less. And then, of course, AAA, you're going to pay the least amount. But you can sell this package off, even though the average amount of risk in the portfolio would be junk. So they take junk and they turn around and give you 70-90% AAA, which of course makes it investment grade, so they can send it out there. They take the collateralized debt obligation and they tie that to a credit default swap. So they issue these collateralized debt obligations, and then they wrap a credit default swap around it to make it AAA debt, which was quite the mess in 2008, 2009. And the reason for it, underlying reason for it, is we simply mispriced the risk. The price didn't reflect the actual risk of the security. And when you misprice the risk, we have problems. So that'll give you a little history in that. Let's move on to the term structure of interest rate and the next chapter.